Good morning, everyone, and welcome to another edition of Morning Markets here at True Potential. We've spent the week updating you on actions in the UK sovereign bond market by the Bank of England, and we want to build on that messaging today, given the actions yesterday. Now, yesterday was the second full day of the Bank of England intervening in the gilt market for both conventional gilts and, surprisingly, those linked to inflation. And it proved to be the largest day of buybacks since the programme was announced 2 weeks ago. However, again, the total amount that was bought by the bank was somewhat underwhelming against the amount they were willing to buy. Recall that they had originally pledged to buy a total of 65 billion in gilts over the course of the 2-week programme. So far, they've bought around about 8 billion, with 2 more days left. So we will update you tomorrow on how that programme went today. But what does it tell us about what we're seeing in the gilt market? Well, the first thing to say is that the problem is not with the institutions that can sell these gilts directly back to the Bank of England. Those institutions are banks, and they are called primary dealers. They have direct lines with the Bank of England. The problem rests with UK defined benefit pension funds. Now, to clarify, that is pensions provided by corporate sponsors. It's nothing to do with the True Potential pensions that are here. It's these specific products where the amount that the beneficiaries will receive is guaranteed somewhat in the future. The problem is the volatility within the gilt market persists. So we referenced yesterday that at the start of markets, the yields on 30-year gilts rose. In fact, by lunchtime yesterday, yields on these 30-year gilts had risen by almost 30 basis points. In price terms, that means that the price of the gilts had fallen by 6% by lunchtime yesterday. However, as we headed into the buyback window, that is where the Bank of England were ready to buy these bonds, the yield on those bonds fell, such that by the end of the day, the price on the bond had fallen only minus 0.5 percentage points on the day. Now, this volatility in price intraday is unhelpful and unsustainable. So what of the immediate future? Well, given that the Bank of England yesterday again publicly reaffirmed that they intend to stop this buyback programme tomorrow, it leaves us looking ahead to the fiscal statement from the Chancellor at the end of the month. And it adds to the communication difficulties we're seeing between both government and the central bank. Because yesterday, the Prime Minister somewhat surprised us all by confirming that there will be no spending cuts in the forthcoming fiscal update. This contrasts with the tax pledges by the Chancellor last month, where there were tax cuts announced, very broad-based tax cuts, which can only be financed by issuing gilts in the sovereign bond market. But yesterday, almost at the same time as the Prime Minister spoke, the Chief Economist of the Bank of England also gave a speech where he reaffirmed his language, his view, that come the next meeting of the Bank of England Monetary Policy Committee in 3 weeks, that there will have to be an unusually large monetary policy response required given the change in outlook from the government. That is, the Bank of England are likely to do an extraordinary rise in base rates, and this may be in excess of 100 basis points. That is, an additional 1 percentage point added to base rate, which would take base rate to over 3%. Now, the Bank of England don't meet for 3 weeks. However, in the same week as they do meet, the Chancellor will both give his fiscal update, where, as we currently believe, there will be the confirmation of tax cuts and now no spending cuts. But the Bank of England also intend to move from buying bonds this week to then selling bonds officially back into the market from that week as well. So there are 3 major events to expect beginning on the 31st of October and into that first week of November. However, this mixed messaging from both sides of government, the government and the Bank of England, is exacerbating behaviour in prices all along the gilt curve, such that yesterday we saw, as we spoke about, we saw that rise in 30-year gilt yield up and then fall back, such that the gilt was largely unchanged to the day. But yet, yields on gilts further down the curve, that is shorter dated gilts which mature in, say, 2 years, the yields on those actually fell by over 20 basis points. In stark contrast to the Chief Economist saying that the bank expect to raise interest rates substantially in 3 weeks. So, what is needed to calm volatility in markets? Well, perhaps the most profound action would be for the government to ensure that their forthcoming fiscal update is largely neutral in terms of gilts that need to be issued back into the market. They need to, or perhaps need to show that the growth forecasts ensure that growth can offset some of the tax cuts. That is, they will be able to raise more revenue in the medium term to offset the tax cuts in the short term. And the market may be able to take some solace from the fact that new gilts being issued into the market may be much lower than is currently feared. We will, of course, update you all on this as the story evolves. Now, later today, we get the next print for US inflation for the month of September. It's going to be a profound inflation print regardless because of the likely actions from the US Federal Reserve at their next meeting. So please do join us tomorrow where colleagues will update you on that specific inflation print. Thank you.
If you're interested in taking your investing to the next level or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.